Chart of accounts is a list of all the accounts kept by the organisation, grouped in ways which link to the balance sheet and income statement. It's like the foundation from which the accounting system is built and allows for the systematic recording of business transactions. The chart of accounts is broken up into 4 categories: assets, liabilities, equity, and income and expenses.
Management with knowledge of assets are able to understand the tracking of use of assets, which will allow the company to meet the objectives in order to reduce the risk of loss and productivity. Therefore, if assets are properly managed, the business can increase profits. Managers who create a database are able to track assets and know who is using the inventory. Business assets can include computers, equipment, machinery, electronic devices, etc. A database will also help eliminate ghost assets. Management with knowledge of assets are able to understand the process of tracking the use of assets, which will allow the company to meet the objectives in order to reduce the company's risk of loss and productivity. Therefore, if assets are properly managed, the business can increase profits. Managers who create a database are able to track assets and know who's using the inventory. The database will help eliminate ghost assets.
A liability represents the claims of individuals and organisations which have appeared from past transactions or events. These include supplying goods and services or lending money to the business. Examples of this are accounts payable, interest payable, income taxes payable, bills payable, bank overdrafts, accrued expenses, and short-term loans. Basically, liabilities show the amount that the company owed to creditors. On the balance sheet is where liabilities become most helpful for the bank managers. Usually liabilities are divided into 2 classifications: current liabilities and long-term liabilities. A current liability is a liability that is due within 1 year of the balance sheet date. An example of this would be accounts payable and customer deposits. A long-term liability is a liability that is not able to be paid within 1 year. For example, this would be bonds payable and long-term loans. Current liabilities are extremely important for business managers as they impose restraints on the cash flow of the company, making it essential that the company has adequate current assets to maintain liquidity. It enables the manager to make a clearer and better business decision. By analysing long-term liabilities, you are able to assess the likelihood of terms being met by the borrower, and you should be able to determine a company's financial strength. Analysing long-term liabilities involves the company's willingness and ability to repay debt. This will help a manager in avoiding bonds or lending to a company that may become bankrupt.
The 4th category of accounts found in the chart of accounts are equity. Equity or owner's capital is another term for the owner's stake or claim on the business. Equity can be broken into 2 parts: capital and reserves. Capital is the owner's contribution to the business, and reserves are what are earned later. Understanding equity and the balance between equity and debt allows financial managers to make strategic decisions in regards to the growth and direction of the business. For example, if a company wanted to expand and purchase a new factory, a financial manager must consider the business's cash flow and whether or not the new asset should be purchased using the company's existing cash or by obtaining debt in terms of a bank loan, or by raising new equity in the capital market in the form of shares. A company's debt to equity ratio is a key financial figure and is often an indicator of a company's health and stability. It is frequently used by bankers and investors as one of the 3 key indicators as to whether a company is worth investing in.
The 4th category within the chart of accounts is income and expenses. Income or revenue is money earned through the operations and sales of a business. Some examples of income include the selling of goods and services, royalties, and received interest from investments. Meanwhile, expenses are the costs incurred while running the business. These can include rent, wages, or salaries, but the type of expenses will vary depending on the business. Knowledge of income and expenses are critical to the manager because together they constitute the profit statement, which contains information vital to the core goal of a business: to generate profit for the owners.
The systematic way in which the chart of accounts is compiled and recorded allows managers to make better informed decisions for the business. It is through their chart of accounts that the various important financial statements are generated. This includes the statement of cash flow, the statement of financial performance, and the statement of financial position, otherwise known as a balance sheet. These main financial statements assist in determining the cash movement, profit made, and financial position of a business at the end of a period. Thus, by effectively recording the business's transactions, a manager can translate the information so to make good business decisions, predict future financial performance for long-term planning,